Somewhere, right now, a $300 million position is quietly disappearing. Not with headlines, not with a press conference, just wallet by wallet, transaction by transaction. A major Wall Street linked institution has been dumping gold at a pace that should concern anyone holding hard assets right now, and the timing is the part nobody's talking about. Because this isn't retail panic. This is smart money moving first, before the rest of the market even notices what's happening. By the end of this video, you'll understand exactly why they're selling, what it signals about the next 90 days, and whether this is your warning to act or your invitation to buy. Stay with me, because this story is still unfolding. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one reason: to help serious investors read the signals institutions don't want you to see until it's too late. Thank you for being here, whether you're a longtime subscriber or just found us for the first time. Before we get into it, if you find value in what we cover here, consider joining the small but growing community that subscribes to this channel. It genuinely helps us keep bringing you this level of analysis. And I'd love to know, where are you watching from today? Drop your city or country in the comments. It's always fascinating to see just how global this conversation really is. In early 2026, something strange was happening in the gold market. Most people did not notice it. The price of gold had just done something incredible. It had climbed to an all-time high, touching levels near $5,600 an ounce. For years, gold had been the safe choice, the steady choice, the asset that wealthy investors turned to when they were afraid of everything else. And for a while, it looked unstoppable. And just as fast as it rose, it began to fall. Gold dropped hard. It slipped below the psychological line of $4,000 an ounce. For many everyday investors, this felt like a shock. Some saw it as fear, others saw it as opportunity. Across trading platforms and online forums, a familiar pattern appeared. Retail investors, the everyday people trying to grow their savings, started buying the dip. They believed gold would bounce back. They believed this was simply a pause before the next climb. But while they were buying, someone else was selling. Not a small trader, not someone with a few coins tucked away for safety. This was a large, sophisticated institution. And it was not selling a little, it was selling a lot. Hundreds of millions of dollars worth of gold moved quietly in a short window of time. This is where the story becomes interesting, because institutions like this do not make emotional decisions. They do not panic because a headline scared them. They have teams of analysts. They have access to information most people will never see. When they move this much money, this fast, it usually means something. And the fact that they did it quietly, without any announcement, without any warning, makes it even more important to pay attention to. Blockchain data, the kind of data that cannot be hidden or erased, showed the full picture. Over several months, this institution's G'd us. Every great mystery has a moment where the mask comes off. This is that moment. The institution behind this massive gold sell-off was not some unknown player hiding in the shadows of the market. It was a company with a name, a public listing, and a very specific role in the world of finance. That company is called Antalpha. Antalpha is not a small operation. It is a publicly traded company listed on the NASDAQ, which means its shares are bought and sold by everyday investors, pension funds, and institutions all around the world. Being listed on the NASDAQ is not something just any company can do. It requires meeting strict financial standards. It requires transparency. It requires trust. So when a company like this makes a major financial move, it carries weight. But there is another layer to this story that makes it even more important. Antalpha is not just any financial firm. It plays a critical role in the world of digital assets and crypto infrastructure. It is known as the primary lending partner for Bitmain, the largest manufacturer of Bitcoin mining machines on the planet. Through a platform it operates called Antalpha Prime, the company provides loans and liquidity to some of the biggest miners and funds in the crypto industry. This means Antalpha sits in a very unique position. It is not purely a traditional finance company. It is not purely a crypto company either. It stands directly in the middle, connecting old world banking principles with the fast-moving world of digital assets. Few companies operate in this exact space. Even fewer do it at this scale. So why does this matter for gold? Because Antalpha did not just hold cash or bonds as safety for its lending business. It held gold. Specifically, it held large amounts of tokenized gold, a digital version of the metal, where each token is backed one-to-one by real physical gold stored in a secure vault in London. This structure allowed the company to treat gold as more than a symbol of safety. It treated it as an active financial tool, something that could be moved, adjusted, and rebalanced instantly, unlike traditional gold sitting locked away in a vault for years. This is a critical difference from how most people think about gold. Most retail investors buy gold and hold it. They tuck it away for years, sometimes decades, as a form of protection against inflation or economic uncertainty. But institutions like Antalpha use gold differently. To them, it is not just a store of value. It is collateral. It is leverage. It is a working part of a much larger financial machine. And that is exactly why this sale matters so much. When a company this deeply connected to both traditional finance and the crypto world decides to sharply reduce its gold holdings, it is not a random decision. It is a calculated one. This is a firm with access to real-time data on lending markets, mining operations, liquidity flows, and global risk sentiment. They see signals long before those signals appear on the evening news or in a typical investor's portfolio. So when Antalpha begins pulling back from gold, aggressively and quietly, professional traders and macro analysts take notice. It becomes more than just one company's decision. It becomes a potential signal about where large, informed money believes the market is heading next. Adding more weight to this moment, Antalpha was not moving alone. Around the same time, reports emerged of central banks in countries like Turkey and Russia also trimming their gold reserves. When individual retail investors sell, it rarely moves markets. But when institutions and central banks start making similar moves at the same time, it tends to catch the attention of everyone paying close attention to global finance. This is the moment where the story stops being about one company and starts becoming about a much bigger question. What do the biggest players in the room know that the rest of the market has not figured out yet? That question is what the next part of this story will begin to answer. To understand why this sale matters so much, it helps to go back to the beginning. Every exit has an entry, and this one started with a bold bet, made at a very different moment in the market. It happened in May of 2025. At that time, Antalpha made a significant decision. The company announced it would allocate up to $40 million into a digital asset called Tether Gold. For those unfamiliar with it, Tether Gold works in a simple way. Each token represents 1 troy ounce of physical gold, held securely in a vault in London that meets strict international standards. In other words, it is gold, just in digital form, easier to move and easier to use as collateral. At the time of this decision, gold was trading around $3,350 an ounce. Antalpha did not frame this as a short-term trade. The company described it as a long-term strategy. It called the asset a key part of its lending platform, a form of protection against inflation and a hedge against the ups and downs of the crypto market. In simple terms, gold was meant to be the steady anchor in a business built on fast-moving digital assets. For months, that strategy appeared to work extremely well. Gold did not just rise slowly, it surged. By March of 2026, the price had climbed dramatically, eventually reaching an all-time high above $5,600 an ounce. For Antalpha, this meant something remarkable was happening on paper. The value of its gold holdings had grown enormously. At its peak, the company's position swelled to nearly $330 million, a massive increase from where it had started less than a year earlier. This is the part of the story where most people would expect the celebration to continue. The position had nearly tripled in value. On paper, this looked like one of the smartest financial decisions a company could make. But then, the story changed direction. Gold entered a sharp and sudden correction. The price began falling from its historic highs, moving lower month after month, eventually slipping below the important psychological level of $4,000 an ounce. For many retail investors watching from the outside, this looked like a normal pullback after a huge rally. Markets rise, then markets cool. That is often seen as healthy and expected. But Antalpha did not simply wait and watch as the price dropped. Blockchain records show a very different response. As gold's price weakened, the company began actively selling. Not slowly, not cautiously. The selling accelerated as the price continued to fall, which is a detail worth paying close attention to. Typically, disciplined investors sell into strength when prices are high, not while prices are actively falling. Selling aggressively during a decline often signals urgency, not patience. By the time the dust settled, the numbers told a striking story. Antalpha's gold-related holdings had fallen from nearly $330 million down to approximately $138 million. That is a reduction of more than half of its total position in just a matter of months. This raises an important question. If the company entered this position at a much lower price, and gold was still trading well above that original entry point even after the correction, why sell so aggressively now? Why not wait for a potential recovery, especially with an original cost basis that was still profitable? This is precisely the pattern that catches the attention of professional macro traders and analysts. It does not resemble simple profit-taking, which tends to happen gradually and with confidence. Instead, it resembles a rapid unwind, the kind of behavior often seen when an institution wants to reduce risk quickly, rather than waiting for better conditions. For everyday investors, this timeline offers a valuable lesson. Institutions do not always sell at the top, and they do not always buy at the bottom. But the speed and timing of their decisions often reveal more than the price itself. In this case, the speed of the selling, especially during a falling market, suggests something beyond simple portfolio rebalancing. So, the question becomes clearer. What exactly pushed a sophisticated, well-connected financial institution to move this quickly? The answer lies in three possible explanations, each revealing a different view of where the market may be heading next. Every major financial move has a story behind it, but the truth is rarely obvious right away. When Antalpha began quietly selling off more than half of its gold position, the question on everyone's mind became simple: why? There's no public statement that explains it directly, so analysts and informed observers are left to study the data, the timing, and the pattern of behavior. Out of this, three main theories have emerged. The first theory is the simplest one: profit-taking and risk management. Antalpha entered its gold position when prices were far lower, around $3,150 an ounce. When gold soared past $500-600, the company was sitting on a massive paper gain. As prices began to cool and slide back down, it would make sense for a disciplined institution to lock in those profits before the market corrected further. This is not panic. This is simply protecting gains that already exist. Many professional investors would call this smart, responsible portfolio management, not a warning sign. The second theory looks beyond gold entirely and points toward liquidity. Antalpha is deeply connected to the crypto industry, especially Bitcoin mining. As digital asset markets shift and evolve, miners and institutional borrowers often need fast access to cash or stable digital currency, not gold sitting quietly as collateral. If Bitcoin-related lending demand is increasing, Antalpha may be shifting its resources to meet that demand directly. In this view, gold is not being abandoned because it failed. It is being converted into a more flexible form of liquidity, ready to be deployed where it is needed most. This points to something bigger about how the world sees value today. The US dollar remains the most liquid, most widely accepted asset on the planet. Gold may hold its value better over time, but when it comes to speed and flexibility, the dollar still wins. For a company managing daily lending operations, having fast access to usable cash can matter more than long-term stability. The third theory is the most serious one and the one worth paying close attention to. It is possible that Antalpha and other large institutions moving in a similar direction are quietly responding to a changing economic narrative. Gold often rises when fear rises, when people worry about inflation, war, or instability in the financial system. If major players believe that interest rates, inflation expectations, or global monetary policy are shifting in a new direction, they may be reducing their exposure to gold as a hedge, because they believe the danger it was protecting against is easing or transforming into something different. None of these three theories can be confirmed with complete certainty, but together they tell an important story. This is not simply about one company selling an asset. It is about how sophisticated financial players are quietly repositioning themselves ahead of the next major shift in the global economy. And that is exactly why everyday investors should not ignore what is happening. When a company with direct access to lending markets, mining operations, and global liquidity flows makes a move like this, it often reflects information the rest of the market has not caught up to yet. Retail investors read headlines. Institutions read patterns. The real question now is not just why Antalpha sold, it is what happens next, both for gold and for anyone holding it, watching closely from the sidelines.